This is Steve Wells.
And I'm Jeffrey Feldberg. Welcome to the Sell My Business podcast.
This podcast is brought to you by Deep Wealth. Are you a business owner who is wondering how to either grow your business, sell it, or both? Or maybe in today's environment, you're wondering how to make your business pandemic-proof. Visit deepwealth.com to find out how you can master the strategies to grow and extract the deep wealth from your business. Visit www.deepwealth.com.
Welcome to episode 18 of the Sell My Business podcast. This episode will be a solo run as Steve Wells is off and recharging his batteries. You're in for a real treat today, as today's guest has not only an interesting story, but his insights are worth their weight in gold. Joel Lessem has over 25 years' experience in successfully accelerating revenues of growth businesses. Under his leadership, Firmex is rapidly becoming a standard for sharing large volumes of highly confidential and sensitive documents for corporate transactions, litigation, and compliance. Firmex is a Rule of 40 business, delivering strong investor returns and high customer and employee satisfaction scores. Prior to co-founding Firmex in 2006, Joel drove the U.S. growth of PointForce, leading to the company's acquisition in 2004. In 1999, Joel co-founded Crescent, a software company that provided online equity research publishing tools for investment banks. Joel, terrific to have you with us today. Thank you so much for making time on your schedule and calendar with us. Why don't we start by having you tell our listeners who you are and your story, because I know offline we've been chatting and you have quite the story that I'm excited for everyone to hear.
Well, thank you very much, Jeffrey. So my name is Joel Lessem. I'm the CEO of Firmex. Firmex is a software company that provides something called a virtual data room for sharing large volumes of confidential documents for due diligence, primarily for finance and M&A transactions. I'm the founder and CEO of this company for 14 years. But my background, really, I was originally going to be a history teacher and realized that at one point I didn't want to be a history teacher, so I was unqualified to do anything, so I got a job in sales. And I worked for entrepreneurs for a bunch of years, about 6 years. And that's how I learned the world of commerce. These are small operations, typically, 10 to 30 or 40 people. And then I had my first startup in 1999 during the dot-com excitement. And that didn't become a commercial success. We'll say it was for a while, and then it didn't. By 2001, it was all over. And I went back to being a salesperson. And then in 2005, got involved with a group of people in starting another company, which is what I really wanted to do, and that was Firmex. And Firmex has been a commercial success, and the company has grown, and it's been sold a couple times, and this is where we're leading to on this call.
And so, Joel, we're definitely going to want to talk about both, because for our listeners, there's just value add on each side. But why don't we start with when you became the founder of the company, what happened in terms of not so much the exit, which we do want to hear about, but what happened after the exit is quite unique. What were some takeaways for you, and then the story after the story?
Originally, Firmex required some capital early on. So we did have some third-party investors, non-institutional investors back in 2008. And then 2016, the company with majority acquisition by a private equity fund called NovaCap. And in that case, the company had been growing nicely and both on the top line and profitability. It's important to them that they have a strong operator running the business. And if there's already one in place, that makes the business even more attractive, because there's always risk in bringing in another CEO or president to run a company. They wanted me to stay on, and they wanted me to keep a fair amount of stock in the company. I happen to work really well with financial investors in the sense that I'm very analytical, I'm very numbers driven. I do mental math in my head. And they really liked that. I had a good chemistry, and we also had good alignment on how we were going to get shareholder returns going forward. I stayed on after they bought out all the other investors and the vast majority of the other founders' equity. They reloaded the company with an option plan. So that's the other thing to note, is that you get and can be entitled to additional stock options. And I really didn't know what to expect. The advice that I got actually was from take enough money off the table. So if it doesn't go well, it doesn't matter. So So I took enough money off the table, realizing that, things didn't work out that well and I needed to go find other employment or do something else, that I had enough money that I would feel comfortable. Anyway, it was a productive relationship with this fund. We achieved our goals as far as continued growth and profitability in the company. So when you've got institutional investors, they're going to have a lot of rigor around reporting and sort of corporate processes. And in my case, that wasn't as big a change maybe for some other entrepreneurs, because I already had investors prior to this. And so while we had a majority in that case, I was always very diligent about reporting to them quarterly, written reports. But in the case of a private equity fund, quarterly becomes monthly, and there's very formal board processes and such. In addition, the concept that someone else owns a majority of your company. You're no longer in control. Effectively, when you do a transaction, there's actually a new entity that's formed that acquires the company, and you get an employment agreement. And for a lot of founders, maybe they don't even have an employment agreement. What do you mean? I'm the CEO because I started the company. And when I got this employment agreement with my name and CEO, I thought for the first time, I thought I've actually earned the job, because I've had validation from an institutional investor to say, we want you. And now I've gone from a founder CEO to a professional CEO.
So let's talk about that for a moment, because what you say is so true. As founders, we do our thing, don't think much about it, and then someone comes along and you have a contract, and it's a different game mentally for you. So you sold your company, you kept a good portion of the ownership in Firmex with the new acquirer. And so they were private equity, but it sounds like they were a different type of private equity in this case, because they kept you on and you had a terrific relationship with them and a wonderful run with them.
When you're bought by a corporation, you might have a widget that's really critical to that business. But we were bought independent of any other corporation. We were just purely as an investment. Really, in private equity, there are different classes of private equity. There's venture capital, growth equity, buyout equity, and then you get some specialists that do like distress situations. We call it vulture capital. But the vast majority of private equity is what we call buyout equity. They only take majority positions. When they buy a company, they're going to have more than 50% ownership. That's their rule. And so that's probably about 75% of the private equity out there, which is measured in the trillions of dollars now. I think it's $1.5 trillion. It's a huge industry. Private equity surprised a lot of people because 20 years ago, it was a fraction of the size. You didn't see so much of it around, but it's become extremely popular for pension funds and other institutional investors to put money into private equity because they've had slightly better than market returns. And so what you find is your liquidity options are increasingly private equity versus going public or versus being bought by a corporation.
And so, Joel, with you, it was a good news story. So when the private equity bought the company and you stayed on, and you mentioned earlier that you work well from the financial side, I'm sure that there's business owners out there when it comes time to exit their company and private equity comes along, in the back of their mind, they have to be thinking, well, do I stay on board and look to work with the new owners, or do I actually exit the company? So what would be some of the factors in your experience of what would make someone not want to stay on board or say to themselves, I don't have that fit or that personality or the requirements to stay on? What would that look like?
Well, I think someone who's just used to doing whatever they want without approval would not want to work with private equity, just as they would not want to work in a company that requires approvals. There's a document that's usually new to people when they get private called the delegation of authority. And these are what level of approval you have. So, you might say, well, any purchase that's outside the budget that exceeds $150,000, you need board approval on. Well, for some entrepreneurs who really became entrepreneurs because they just couldn't bear taking any instructions from anyone else, this might bother them. They like having complete and total autonomy. Whereas if you've got a personality that's more about, yeah, I can understand why this is important. And it's about having financial controls to make sure there are no surprises. These are other shareholders. They're important. I am sharing my company now with other people, and they're just as important as me. And I think for some people that might not be palatable. For other people, that's just fine. And so I think that's the entrepreneur that may want not to continue on. I think the other factor is an entrepreneur who's maybe tired of their business and says, look, I've been doing this for a long time. I'm ready for a change. I've put in my 15 years or 20 years and I'm ready for something new. And that's totally fine as well. I know peers of mine who have done just that with private equity. They said, look, I put in my time. I need a change, and it's a personal decision.
Absolutely. Now, in your case, Joel, something interesting happened. So you started Firmex, you sold it, you stayed on.
Right.
Why don't you tell everyone what happened next that puts you really
Sure.
in a league of your own?
Well, private equity funds will typically hold an asset for 3 to 6 years. It's a relatively short time. So 2.5 years later, I sold the company at request of my new owners to another private equity group. And so that was done last year. So I went through that process as well. I think what's interesting about the two different processes is the first process was what I call a non-brokered process. It wasn't an auction. It was a proprietary process. The private equity fund had approached us, and we didn't run an auction process. And so those were interesting experiences. The fund made a good return, the initial fund, as did the original investors. I think it's important when you have investors, whether they are, family offices or angel investors or private equity funds, that your job as a CEO is to drive shareholder value for everybody. You have a lot of other responsibilities to your employees and your customers and your business, but that's one of them. It's a really key cornerstone. So when you check that box multiple times, you feel good about yourself. Yeah, I'm doing my job and I've been successful at my job. And so we sold to another private equity group, and which was really good. We actually had an auction process. We were a bigger company. We drew more attention. It was actually the group we favored. And so now we have another ownership group. Relationships generally work when everything's working really well. Relationships are really tested when things aren't going as planned. And I would say COVID was not something anyone had planned. And, we've been faring probably better than expected once we were hit by COVID. But, you really get to know your partners well when you're under stressful times. And so it's been going really well. I really like this group. Interestingly enough, I'm still really good friends with my chairman from the last private equity fund, who lives a mile away from me, and we go for walks every month. I think the real key here, when someone is considering private equity, it's the relationship with the lead partner. Do you have good chemistry with that person? Because that's going to make all the difference in your relationship going forward and how much you enjoy your job.
Absolutely. And what's interesting with the two exits that you had in staying on with the same company at Firmex, one was without an auction and one was with an auction. So when you look back at both experiences, do you have a preferred type of exit scenario? And I know some of our listeners would be saying, well, what is even an auction and should I even be considering it? So would love your thoughts on that.
So I've actually gone through 4 diligence processes. 2 have closed, and 2 of them were auctions and 2 of them were proprietary, and they both have a 50% success rate. So they tend to be more successful when you're larger, but there's all sorts of reasons deals cannot close. I think I mentioned a lot of first timers, when they get their first LOI, think they've got a deal. Closing percentage on an LOI is probably about 40%. And so you're only in your early stages. I would say that because we had an auction process early, we had a pretty good idea on the value of the business. And so when 15 months later, when NovaCap came around, we had to make a decision when they came with a preemptive offer to us. Do we run a process now, or do we think it's a fair deal based on a good understanding of the market and multiples? And the risk of delaying their process with them, you say, well, listen, we're going to run a process, come back later, versus just getting it done. Time is risk in any deal. So we opted to choose to go forward with NovaCap without a competitive offer.
Now, it sounds like one thing that worked in your favor, though, is because you already came out of an auction recently, you had vetted what fair market value was.
Right.
So let me put you on the spot, if I could, Joel. Knowing what you know, if you were a first time out there, going to be selling your company like many of our listeners for the first time. It might be their only kick at the can, so to speak.
Right.
Would you do an auction or would you not do an auction?
I would generally lean to doing an auction, mainly because I think you will, generally speaking, get better results out of an auction process, for sure, because it's a competitive process. People are going to have to put their best dollar forward. In fact, in an auction process, it's very much like selling a house where you get your initial bids and you take your top three and you go back and say, okay, well, you guys are in the top, you're going to stage 2 of diligence, do a little more homework and then put your best, and they know there's a lot of pressure. And I mean, the uptick on the second bids was 15 to 18% more from the same bidders. If you've got a good auction going, if you got enough people at the table, you're going to get a premium for your company. Now, keep in mind, if you're rolling stock, meaning you're staying on and you're keeping your stock, you're also paying that higher bid yourself by rolling your stock into that business. And in fact, sometimes when you're rolling a lot of stock, so we had some senior executives who were rolling 100% of the stock, they actually wanted a lower bid because it really didn't matter what the value of the company was bought for. What it also makes it easier to make returns for your next shareholder because you're at a lower value. You got to make a multiple on. And so that's a little nuance. If you're exiting 100%, it doesn't matter. But if you're going to stay on, you kind of want them to pay a fair price. You don't want them to pay something that's over market because that'll be your challenge to make a multiple of the over market price afterwards.
Spoken from the trenches. As we begin to transition into the next part of your story with Firmex itself, because that's really a whole story in and of itself, as we close out on your own personal experiences with your exit, if you had to look back and, I don't know, pick maybe 2 or 3 takeaways that you would like to share with our listeners, what would those be when they're thinking about their own exit?
First of all, getting a deal done it's a pretty intense process, and you really want to be well prepared for that process. You want to be well organized, 3 or 4 or 5, 6 months or however long you're going to spend on it. If you do a marketed process, it could be a full year. It's going to be 80% of your consciousness. I mean, it's really going to be full. You've got to be prepared to prioritize it. You've got to be really well organized, well ahead of time with your documentation. And you should be thinking about it even before you get there, as far as like, oh, I shouldn't do that because it's going to affect the sale of the business down the road. At the end of the day, I think it's a great experience from a professional perspective, from a life experience perspective. I'm really glad I went through it. It's a trying experience, but I kind of equate it to, I play a lot of sports. So if you're in the playoffs, it's very stressful. You could lose and get kicked out of the playoffs and not win the championship. And every stage is sort of like going from the quarterfinals to the semifinals to the finals. And then now you're getting more and more tense as you go forward because there's more and more at stake. It's same in a deal process. As you get further and further into the deal, the more tense you are because you've got so much money that could be going into your pocket or not going into your pocket. And it's nerve-wracking. But when you close that deal, you feel like you've won the championship. And it's a great experience. The neat thing about staying on is you get to play for another one. In my situation, it was a little different in the sense financially. I had a large founder group and some investors. It was also materially valuable because let's say you leave half your money in and then you get to triple that half amount. You actually come out with a bigger chunk on the second bite of the apple. And you just keep repeating that. The financial opportunity gets bigger and bigger as you go forward, which is valuable if the exit's not going to be massive to start with. But I really enjoy the experience. Part of it I don't. I mean, obviously, look, due diligence is a very long, inquisitorial process that is somewhat dull in some regards and time-consuming. I've seen it both ways, so I know.
And I think that's a terrific segue now into Firmex, which is also the company that you founded. And so Firmex is a virtual data room company. If you want to have a grown person frown, you mentioned due diligence and those 2 words do that.
Sure.
But like you and I were chatting offline, Joel, the quickest way to have the deal actually complete and have a high value is to give confidence to the buyer that they know everything that they should know. So talk to us about Firmex as a company now that's providing virtual data rooms and why everyone should be doing their own virtual data room even before they formally bring on an exit team and an investment banker.
Well, virtual data rooms are specifically designed for deals, as opposed to, for example, a Dropbox, which is just designed for generically sharing documents. They have a lot of detailed reporting on who's looking at what, interest potential investors or buyers are showing. There's a lot of user permissioning. You can really control who sees what when, and you can watermark the documents so you can protect your IP. You can even restrict how the documents are either downloaded or not downloaded, or not printed or printed, and all that kind of thing. But what's really important is the perception that you're taking it seriously. Data rooms are not very expensive. A data room costs all in like $5,000. Just your legal fees alone at minimum are going to be $250,000. And if you have a banker, depending on what you're selling it for, it can be over $1 million. It's really a rounding error in the whole process, but it's the perception. It's kind of like if you were going to go out on a date, would you show up in a car that's all rusted and beaten up, or would you show up in something nice? It's going to make an impression. What's really critical is your understanding of your business, but also how you articulate it and how you can prove it comes in all sorts of ways, whether you've already gone to the trouble of having your financial statements audited for many years, but also being extremely articulate in the analytics and the proof that this business will generate significant future cash flows for whoever the investor is. If you can have all this information grounded in facts, presented really well, that's really important. One of the things I have to say M&A advisors do a really good job at is beautifying those documents, but also expressing that information in really compelling ways. Getting that all organized, working with your advisor well ahead of time, obviously having the technology like a virtual data room to present the information really well in a very secure manner and to really get an understanding of buyer interest is all important.
I would even take it a step further using the same analogy that you gave. And at Deep Wealth, one of the things that we've embraced as a best practice for us, before you begin the exit process for yourself, so before you hire your advisors, before you hire your investment banker, to do a due diligence on your own company, part of which would be have your own virtual data room to put all that information together. And I know at first glance, business owners are saying, well, why would I spend the time and money to do that? And in our experience, it's like you said, Joel, you don't get a second chance for a first impression. So when you go to an investment banker and you have your own virtual data room, you're prepared. You have all the information in there. You've thought things through. You see the skeletons in your closet that you didn't even know were there that you've had a chance to correct. In our experience, particularly with investment bankers who trade on trust, you're guilty and never innocent. So even if you put a skeleton out there and you correct it, the perception that we find with investment bankers, that's what they're going to remember. So if you show up in your analogy in that car, that's not a rusted car, but it's a brand new car, it's all sparkling and it's clean, and you put your best foot forward with the investment banker, with your own virtual data room, in our experience, that goes miles and miles in terms of increasing the perception of your investment banker and ultimately, and most importantly, increasing the value of your company when you're doing that. So, Joel, you see a lot of deal flow at Firmex. When it comes to virtual data rooms, what would be some do's and don'ts that you can pass along to our listeners?
Our clients created over 15,000 data rooms last year, which is probably 15% of the deal volume in North America. Whoever's administrating your data room should be well trained. The thing you never want to happen in a data room, the wrong person sees the document they're not supposed to see, or you post a document you didn't need to post, because when you post a document with email notifications that go out to all the buyers and then notify, you want to be very, very careful on how you set your permissions and how you post information to this data room. Because what will happen in the process is, typically speaking, in a data room process, when you first go out, you bring bidders in, you have what we call diligence phase one, which is maybe 50 documents, which they're using to write their offers. During that phase, they'll start asking for a few extra documents. And to be fair, you need to disclose that same document to all the bidders. And curating that information, making sure they check it first before it goes up, making sure it's well organized, making sure the right people are seeing it. And that'll keep going. When you get into a comprehensive diligence, really phase 2 diligence with that short list of bidders, you're talking, depending on the size and nature of the business, often hundreds and sometimes thousands of documents. And those documents are not all pre-existing documents. Those documents sometimes they're in response to answering questions. Typically, a diligence question, it's called an initial question list, is typically 200 to 300 questions. That's just the initial volley. And then you'll get, ad hoc questions coming in response to your answers. And sometimes they'll be asking for details about your business that require a bunch of analysis in another spreadsheet. You got to be sure whatever you publish is well vetted, triple checked, because if there's an error in the model or there's an error in something you said, then they wonder about everything else you said. And remember, for the buyer, this is a big risk they're taking. They're making a substantial investment. Whoever the lead corporate development person is or the lead private equity person is buying this company, if they miss something in diligence, it's on them. They're they're worried about their employment. Remember, they're not necessarily entrepreneurs. They're buying your company. These are paid employees that care about their employment and can be fired. It's unlike a lot of entrepreneurs who are immune to being fired. So you do not want to make them nervous or worried by, oh, sorry, that was a mistake. Let me just send you something else. And that starts happening consistently. They will get very skittish very fast. And keep in mind, they have other options. They don't have to buy your business. And so make sure anything you publish is really vetted, locked down, and there's no errors.
And Joel, you've mentioned this before. For our listeners, though, it's worth repeating. You've made a very clear case why emails simply won't cut it when you're trying to sell your company. And you've even mentioned other services out there which aren't virtual data rooms, but people may be tempted to use because they're free or they're already used to using them. So from a virtual data room, my takeaway from what you're saying is it gives you a professional image. You have security in terms of controlling who sees what, and you can track that and you can watermark things so that you know who's reading what and where it's going from. Is there any additional reasons of why other business owners should only be thinking of a virtual data room and not even looking elsewhere?
Well, those are pretty strong reasons. You don't want information to leak, especially if you've got a situation where whether you're using email and you send it to the wrong Steve on your email, that happens to be your sales manager, and they didn't know you were selling a company to a competitor, that's really going to backfire in your face. One of the biggest challenges of selling your business is keeping it confidential. If you've got a staff of 50, 100, 200, 300, 400 people, and all of a sudden you're buried in your office all the time, you do not want it to leak out that the business is for sale. Because once that leaks out to your staff, beyond maybe your inner circle of executives that have to be included in the process, they worry. And rightly so, because there's uncertainty. What's this new owner going to, the company's for sale. Did you hear the company's for sale? God forbid it leaks that you're selling it to a competitor. And then they're like, oh, we're all going to lose our jobs. They start heading for the exits and your deal collapses. And then you just lost a bunch of employees. And that's all you've accomplished. So you really want to do something that's secure, that's not going to leak. That's probably maybe the other thing. Never mind being careful with how you manage yourself through the process. That would be the other reason, to make sure you use something secure and you don't just start winging things around by email. Look, companies get sold over Dropbox. Companies get sold over generic systems. You can do it. People get from A to B on a skateboard, but it's not the best idea sometimes.
And when we talk about selling your business, really you have one chance to get it right. You want to make it count across the board with everything. And like you said, Joel, perception is reality. So as we're recording this interview, we're still in the middle of this coronavirus pandemic, and business as we know it has changed. I'm curious, what's that been like on the back end of your operations at Firmex with the pandemic? And what have you seen in the marketplace now in terms of transactions?
Because we're a cloud-based software company, and we can all work from home without any disruption. We made sure, by the way, late January, I was pretty convinced, based on medical friends of mine, that the virus was heading our way. It was going to get out of China. It's going to be everywhere. So we made sure by late January that we had full infrastructure in place in everyone's houses so that they could literally walk out of the office and go home and keep working. And so sure enough, by second week of March, I think everyone was at home working from home with no disruption. I actually think, other than missing this very social company, people missing seeing people in three dimensions and hanging out with them and going to lunch, for a lot of the commuters, it's actually been a real benefit to work from home. They've been saving hours a day. They're better rested. They can spend more time with their families. I think this is the case for many companies in COVID that have this kind of business. And so that's actually been a very positive. And we've adapted quite well with the various video conferencing technologies. As far as deals were concerned, deals really took a hit. The number of M&A transactions were already weakening pre-COVID. You go through cycles, it's like any market. And then when COVID hit, they really stalled, particularly in April and May. Even in the software business, which is more immune, even software deals stopped dead in their tracks late March, unless they were really far along. And because people really didn't know, I think it was more the shock and awe of this, oh gosh, we're in this pandemic and no one's ever had an experience of a pandemic like this in this century anyway, not for over 100 years. And so deal volumes really dropped significantly. We have a transactional piece of our business, which fortunately is only 30%. That was impacted by that. The subscription business was not impacted, which was great. We were really happy. Those are people that buy annual subscriptions, and they had enough activity that they kept going. And I would add that actually the activity is actually rebounded now. It'll be interesting to see with the resurgence of COVID if that hampers the recovery of deals. The biggest problem that people have doing deals right now is part of the diligence process is an in-person meeting. And that's not so tough if you're in the same country. That gets really tough if you got to cross borders. I was actually talking to a cousin of mine who's a private equity owner, a founder of a private equity fund as well. He's looking at a deal in a different country. And he's like, I got to go there. But when I come back, I got to spend 2 weeks in quarantine. We were lucky actually at a deal in another part of the world. They had such strict laws that we'd have to spend 2 weeks in a hotel, in a room in a hotel in quarantine before we could actually go meet them in person. So those are the kind of issues that are making it harder to get deals done. But deals are getting done. What's interesting, Europe was really at a standstill in April and May, and they've really sprung back. We've seen more activity coming out of the Americas now. We're probably at 70 to 80% of what we were pre-COVID. So it's still active, and people are still trading assets. There is a lot of money on the sidelines that needs to be put to work. And so there are a lot of private equity funds that really want to put their money to work. And if you have an attractive business, they'll figure out a way to get a deal done.
You're exactly right, Joel. Our thesis at Deep Wealth and what we share with business owners who it's counterintuitive, they're shocked. We say two things. Number one, nobody can time the market. I don't care who you are and what you say. If someone tells me they can time the market, I like to run the opposite way as fast as I can. But when you're prepared, you have choices. And a pandemic brings with it many negative things. But sometimes out of the negative comes the positive. So if you're a company and you're prepared, in our experience and what we're seeing right now is there's fewer sellers and there's fewer buyers. So the demand is now increasing. And I would say you have a higher quality buyer out there because these are the buyers that have the funds and they've been in the business, they're here playing the long game. And you also have fewer sellers. If you're prepared, this is a terrific opportunity to get what could possibly be a once-in-a-lifetime opportunity, that much extra value for your company.
There are some businesses that are performing extremely well in this environment. Some that may surprise you. I mean, there's some obviously collaborative tech companies, and we're on Zoom right now, so I imagine that business is doing extremely well. But, vets are doing extremely well. Why? Because everyone's getting puppies. You can't even find a bicycle within an hour of this city. So there are certain consumer products that are doing extremely well. You can't even get a hot tub for your backyard right now. So any type of product associated with how people at home products are selling like crazy. There are other industries that are benefiting dramatically from COVID. Those ones, and I know actually one company in that mix that is selling for an incredible amount of money right now. It's closing next week. So I think if you're in an industry that's benefiting from the at-home environment, then certainly they'll do well. In particular, I think people are not going to forget COVID. easily. Industries that are prospering in this environment will be given a premium going forward because you never know when the next pandemic's going to hit. It's kind of it's a black swan event that could happen again in 5 years. We have no idea, or 100 years. But I do think those people that have been resilient in the wake of COVID are going to get a premium for the business.
Well, interesting times. It never ceases to amaze me. What's in vogue today can be out of vogue tomorrow, and all you can do is be prepared and try your best. So, Joel, as we begin to wrap up here, a few more questions for you. You've been on both sides of the table now as a founder, a business owner, building a company, selling the company, and now going on the other side of the table of owning that company and putting your investment vis-a-vis your ownership in the company forward again and getting the returns as an investor. And also, while you're doing that, Firmex being in the business itself of being a virtual data room. So it's a broad question that I'm going to ask you. You can apply it to any which way that you like. Knowing what you know now, if you could just do one thing when it would come to building a business, growing it, selling it, some of the above, all of the above, what would that be from what you've seen and learned over the years?
At the end of the day, I always tell people what you want to do with a business, for whether you stay or exit or keep growing or how you run it, is deeply personal. And for me, the thing that really matters is that the business is managed in a way that aligns with my values. And I think these are values that are shared by my leadership team and by most people. And those values are things like honesty and fairness, collaboration, and shared success. I think the thing that I really enjoy the most, so assuming you have a commercially successful business, for me, at the end of the day, for most people, if you sell a company, whether you sell it for, a few $1,000,000 or many million, it doesn't really matter, because at the end of the day, there's enough money for anyone to live on. What matters for me, and what I've learned over the last 14 years, is have I helped other people be successful? I get a huge kick. I'm one of the village elders in our company at 53 years old. So I watch a lot of young people come into the company and progress not only in the company, but in their lives. They meet somebody, they get married, they start a family, and they go through this journey and they enjoy their job and they enjoy what they do and they like the company. And to me, that's very meaningful. We have a very positive Glassdoor rating that somehow creating Firmex made a difference to other people in their lives and their happiness and their professional success. And so to me, that's really the interesting and the most rewarding aspect of running a company.
Well said, and some terrific insights. We'll put all this in the show notes. If someone wants to find you out there in the virtual world, where can they look?
LinkedIn, that's a good place to find me. By all means, I'm happy for them to reach out. They can send me an email as well.
Terrific. Joel, it's been an absolute delight with you today just to hear your story and your exit adventure many times over. Thank you so much for that. And as we continue to work our way through the pandemic, stay healthy and safe.
Thank you, Jeffrey. You too.